In this module, we start the discussion about what happens when we know that we won't be able to collect some or all of the money that someone owes us. We have two methods that we'll use to account for that, and they are called the direct method and the allowance method. In this lesson, we're going to take a look at the direct write-off method to accounts receivable. This one basically says, we have a customer that's not going to pay us money, so let's write that off. And we will write it off to an expense account that will reduce the amount of our net income. We'll record that as a bad debts expense, and we will credit the account of the accounts receivable, the customer. So here's an example of, so the first one was an example of there's the write-off. Now what happens if that customer comes back and pays the amount that they owed us? That's great, right? Well, what we do then is we put it back into accounts receivable, credit off the bad debt expense because it's no longer an expense of our operations. Then we record cash and credit the accounts receivable. So let's talk a little bit about that direct write-off method. It does not properly match revenues and expenses in the accounting period in which they occur. For example, I could have sold something to someone in November, thinking full well by my end of the year in December that they will pay me. By January or February, I realize that I am in fact not going to be paid. So in November, I have recorded the sale for the year 2019, let's say. So my revenues and expenses have that income for 2019. In 2020, I realize that I'm not going to be paid for that amount, so I have to recognize an expense. So I have the revenue in 2019 and the expense in 2020. The direct write-off method does not allow those two to match. The next method that we look at in the next lesson, called the allowance method, does allow that. So in a nutshell, direct write-off method, not generally accepted accounting principles. If the bad debts are material to the financial statements taken as a whole. All right, let's go to our practice set and we're going to work on exercise 7-4. Let's do a transaction using the direct write-off method. We have Dexter determines that it can't collect $45,000 of its accounts receivable from its customer Lear Company. So on March 1st, let's just put this in. Here's our subsidiary ledger for Lear Company, and we know that they currently have a balance of $45,000. We know on the 11th of March that we are not going to be able to collect that. So we do the direct write-off. It goes directly to bad debt expense, and the amount is $45,000. We do a credit to the accounts receivable, and here we say accounts receivable, and we do note the name of the company, so we know which subsidiary ledger to post it to, and that is $45,000. On the 29th of March, Lear Company unexpectedly pays its account. So let's just back up here a second. So on the 11th of March, let's get our subsidiary ledger updated. I credit the balance off. So balance at this point, let's just do that. Balance at this point is 0. Now, on the 29th, they paid it back. The first thing that we have to do, as we discussed, is to put it back into our accounts receivable. And they repaid the full $45,000. If they had not, we would put whatever they repaid back in accounts receivable. We wouldn't put the full amount back in. And now we're going to credit bad debt expense. $45,000. Let's go down here and update our subsidiary ledger. So on the 29th, I'm debiting $45,000, putting it back in. And then on the 29th, we also have the receipt of cash for the $45,000. and now we take it out of that accounts receivable. So why do we run it through that accounts receivable like that? Because if you look at this, right, we could have just done a debit to bad debt expense or a debit to cash and a credit to bad debt expense. The reason we run it back through the accounts receivable account is so that we have a history that this account at one point we assumed was not going to repay us and we wrote it off. They did eventually pay us, so that's a good thing. But the fact that we had decided that we had to write it off in the first place was not so good. So we want to keep that historical record in our account.